This is Capital Ideas TV. Coming up, the CEO of TECSYS, not the state, the supply chain management company thriving after a game-changing move. The man behind Empire Industries, from steel fabrication to the coolest rides in the world. And the founder of Nanotech Security, disrupting anti-counterfeiting. TECSYS is a supply chain management company founded in the early 1980s. Its customers include Honda, Canon, and Humana. The company says its recent move into healthcare has been a game changer for it. The shares have tripled in the last 5 years, but TECSYS says there are a lot more gains to come. We recently talked to the CEO, and here's that conversation. So Peter, supply chain management is sort of a broad term. Could you explain how TECSYS fits into that, and also the visual component to it?
Sure. The supply chain marketplace that we fit into is, really divides into two segments. So I'm going to talk first of all about the complex distribution segment, which we would know as, distributors of electronic components, suppliers to big retailers, suppliers to manufacturers, who are typically buying from large manufacturers, buying by the pallet, breaking that down into cases or eaches and distributing it to a wide variety of clients. Typically, the markets we're in, these supply chains require traceability. They may involve hazardous materials or products that expire, safety-related products, so you require lot tracing and serial tracing and so on. Add into that, of course, the rise of omni-channel, where you've now got consumers buying online and complicating that whole supply chain. It's no longer the nice, neat supply chain that it used to be. It's now got to be completely agile and flexible to deal with whatever users demand. So we supply software to facilitate that type of agile supply chain.
And then you say your healthcare side of the business is a real game changer. How come?
Well, the hospital market is a market that is pretty much virgin territory at this point. I mean, if you look at a typical hospital network in the US, they might be 20 or 30 or 50 hospitals that are part of a network, and they are still pretty much managing their supply chains the way they did 20 or 30 or 40 years ago. The shelf looks empty, pick up the phone, call a distributor. We provide software to them to actually automate and manage the inventory, whether it's medical supplies or pharmaceutical products or implants, manage it at the nursing station, in the operating room, in the cath lab, and we've got solutions that allow nurses and clinicians to just do their jobs, focus on the patient, and in effect, our software and a few hardware products that we also implement look after knowing what they've used, when they've used it, who they've used it for, and who to bill.
Now, Peter, who are your partners and how are they important to your model?
Well, the hospital market particularly is a very, very large market. We have about 6% of the hospital networks in the US right now as clients, but even in those clients, we're only about 12% penetrated. So we think there's about a $600 million market opportunity just in our base of accounts alone. And then there's probably about a $10 billion market opportunity in total. And we are the hands-down front runner in that market. There's nobody else doing what we do in that space. So we will never be able to address that market and get systems implemented in a market that size at any reasonable pace without a network of partners to help us get the software implemented.
Let's talk some numbers here. Your booking growth number was a record in the last quarter. Tell us about that. Tell us about where you stand with revenue and earnings and what kind of projections we're looking at here.
Sure, although we're a lumpy business, our revenue tends to be very solid from the standpoint that a substantial portion is recurring, about 40% is recurring, and customers that join us essentially never go away. So, over the last 4 years, we've grown at a compound annual growth rate of 12%. Year before last, we actually did about 18%. When Trump came into power and started threatening to tear up the Affordable Care Act, the healthcare market went sideways on us for about 8 months. So last year we essentially flatlined. But as you say, bookings are now on the rise, up 64% in the first quarter. And we're looking at what looks like a very strong fall now that has sort of passed by.
You're sitting on about $23 million in cash. How acquisitive have you been in the past, and what are you going to use that money for?
We've acquired a number of companies in the past. Our last acquisition was LodgeD that we acquired about 3 or 4 years ago, which assisted us with point-of-use technology for managing inventory in the OR and at the nursing station. And so we've been fairly successful with acquisitions in the past. The last few years, the pricing of acquisitions has been completely out of line with our own valuation, and so we've stayed out of the acquisition market. Today, our own valuation has come a little more back into line with some of the available acquisitions, and so we are looking for acquisitions. Particularly, I would love to find the right acquisition in Europe to establish more of a beachhead there. We're about 5% of our revenue in Europe right now, but it's been a slow and painful process to grow that revenue. I'd like to accelerate that. And there's also some opportunities within healthcare itself to get even deeper into the hospital.
Your company's been around for a long time. How would you characterize the way the public markets and investors in general see TECSYS?
Yeah, I mean, we have been around a long time. The company was founded back in the 80s. In many ways, though, the company you see today, I would say, is 10 years old. We developed software back in the 90s for the supplier to Walmart space, but that legacy code was entirely rewritten in the last 10 years to be a pure, web, Java-based product line that's written in the latest technology. And the marketplaces and the types of clients we're serving today are really all, have been developed in the last 10 years. Lastly,
Peter, you own a healthy 36% of the shares. What do you think that says to the market that you're so fully invested here?
Yeah, the 36% number you're referring to is actually the full insider ownership, so that's partially me. It involves my brother and his wife and so on, but that's the insider chunk. And we have also eliminated our stock option plan, right? So even our senior management team are on a mandatory stock purchase plan rather than an option plan. So the founders and the senior management team, we believe, are fully aligned with shareholders. We're focused on long-term value growth, and I think if you look at the last 7 or 8 years, you'll see a pretty consistent, 20 to 30% annual return to shareholders. So that's our focus, and we want to keep it going.
Empire Industries has made a fascinating transformation from plain old low-margin steel fabrication to making some of the coolest rides in the world for the likes of Disney and Universal. The company is now branching into owning and operating its own rides. We recently talked to the CEO of Empire, Guy Nelson, and here's that conversation. Don't explain in detail because I've seen a chart and it's complicated. You said it took 6 months to put together, but a co-venture where you're looking to unlock hidden value, own and operate within your own company, and you're targeting Asia through this as well.
Yes, yeah, both North America and Asia. So we're the idea was, 2 of our theater products are equal, actually 1.5 theaters equals our capitalization to be a manufacturer. So it's a capital intensive business when you own your own product. So I knew that going into it, but I also was recognizing that there's tremendous recurring revenue, recurring profit in the right locations with the right tourist-based location partner, that it could be a great business. And we knew it was a great business because we watched our customers enjoy the benefits of being in that side of the business. Of course, Disney and Universal are at the epitome of that with theme parks, but this is tourist-based locations. This isn't just normal cities that have lots of tourists that are coming to there and want to expand their experience, right, with a world-class attraction, which we make. And so we embarked on that, and I capitalized it found a strategic partner that wanted to put 2/3 of the money up, and Empire would put 1/3 of the money up. And we're going to build a couple of theaters, one here and one in China, and prove it that we can do this. We obviously can do it. We've done it for others. But that's a different business. It's when you own your own attraction, it's a different business. So I've changed my organization. I've hired some people to allow me to get into this business more aggressively, and that's what we're doing.
Let's focus on financials now. Where does Empire stand with revenue, earnings, backlog?
Yeah, so I'd say about 120 million in sales. Annualized our EBITDA for the last, trailing 12 months, about 8 million EBITDA. We would have record backlog. We've been awarded, I think that's really when the market started to take notice of us in the last 3 months. We were awarded a $120 million contract with one of the large companies. It was the first multi-year, multi-park transaction. I think last time I met you, we were on the verge of announcing that. We hadn't announced that. But the big guys are looking around and saying, we've got billions, we got big programs that we need to spend. And So strategic alliances with them is there's not enough capacity in my industry to really do what they need to do, and so we've found a sweet spot where we're growing, and I've grown from 10 engineers to probably 100 engineers today over the last 5 years. Mm-hmm. So we have capacity to do more, and we're pretty good at what we do. So that announcement a couple months ago woke the market up to who are these people that are like a little micro cap company, and then so people are taking notice of us. Our liquidity's improved as well. So we're starting to get some micro cap managers. But I would say before that announcement, we were largely retail and insiders. Insiders own about half, right? But largely retail, the rest. And I think people are starting to take notice now.
So that's essentially the investment case, the changes you've made. The growth, you've got Disney and Universal as clients, demand from Asia, Middle East, and
North America.
And North America, of course. Take us out 1 or 2 years. What does the company look like? Where's the stock?
Well, that would be a forward-looking statement. So I don't know where the stock would be, because the market will figure out where it wants to take us. But I do know where our company's going to be 2 years from now, and that will be, we'll have a couple of co-ventures in operation. We're capitalizing the company to do that. We're not through that capitalization, but the letter of intent that we've signed and is pretty specific. So before year end, we'll have the capital to do 2 theaters, and people will know that that we're in that business. People will continue to know that we're in the business we're in, which is generating increasing margins from the Disneys and the Universals and the products and the programs we're involved with them. And then we also have our own product line that's coming on stream. That will be feeding that growth market in other places. So you're going to see more business coming from that. Our margins have been suppressed over the last 3 or 4 years because we've been building product for the first time. Our product, engineering and designing, and it's complicated first time, learning curve. It's not an excuse for lower margins, it's the reality. I mean, you build something the first time, it is more complicated. Second, third, fourth, fifth time. And we've proven that with our own flying theater. I mean, our first flying theater that we built a number of years ago, we made no contribution margin on that, but now we do, right? It's easier to build them after you know what the print looks like. But it's your print, and that's the difference. We have a lot of goodwill in that. So I'd say if you look out a couple of years, we're going to be just even that much more interesting a company. Maybe a few more people know about us.
Nanotech Security says it's disrupting the anti-counterfeiting security and authentication market. It's doing that by using nanotechnology instead of traditional holograms. Its technology is used in things like banknotes and tax stamps, and it's branching into other areas. We talked to the CEO of Nanotech Security. He's the founder as well, Doug Blakeway. So Doug, anti-counterfeiting is a very hot topic right now. How does Nanotech Security fit into that? What exactly does your company do?
We fit in by implanting or embedding nano-optic holes, so nano-sized holes in virtually any material. We make holes in pillars, and from those holes in pillars we get very bright playback images. So we can design something to give you a specific color along with a specific image, and it's directly put into such things as plastic, wood, metal, directly into them, or we can put them onto a label and have the label applied or attached. We're disrupting the holographic marketplace with our type of technology. It's new because it operates in such a small scale. You can't photocopy it, you can't scan it, or even take a photograph of it and be able to replay it back directly in the item. And so what the industry really wants is they want an article that is very expensive and complicated to build the mastering and to be able to embed it, but when you run the production of the item, it to be very inexpensive and fail-safe.
So do you have first mover advantage in this sector? Are there competitors nipping at your heels?
Our competitors are holograms and the holographic industry, which is basically micro in design, 1,000 times larger than what we operate in. We have no direct competitors in the nanotech space. So nobody doing nanotech that we're competing with. And we hold patents that have been issued, as well as we have a lot of applications for further patents. And we tend to wrap those in trade secrets so we don't have to expose all the technology out there.
Now, I understand within your business, optics growth is quite strong right now. What is that exactly? Explain that.
The optics growth is taking something that you use, nano-optics being something that's very small and it's optics just like glasses, and being able to magnify the light source that comes in and then reflect it back out. So in that optics area is we operate below wavelength of light. So if you looked at a chart, you would see wavelength of visual that we see somewhere around on the top and 600 nanometers and on the bottom about 400 nanometers. 400 nanometers being the UV spectrum and the 600 to 700 nanometers being the infrared spectrum. We operate far past that down in small, and as an optics, that allows us to form these beautiful figures or images and have them play back unobstructed and the light being able to be pulled directly into them.
So your big areas of growth, banknotes, tax stamps, talk about those, and also some of the other areas you're branching into, and you've got some samples here as well.
Correct. Our main focus for the next 2 years is going to be on banknotes and tax stamps. We're talking about a $2 billion a year marketplace. It's something that's very concentrated in the world of banknotes. There's about 165 billion banknotes produced annually, and in the case of tax stamps, about 140 billion tax stamps produced annually, and that's in quantities, not in dollar values. And then what we tend to do is we license our technology so you can apply it to both of those mediums. So we have a recurring license revenue model coming back from that. On top of that, we're branching out after that time period into cosmetics and into pharma, and then into luxury. But during this time that we're concentrating on, as opportunities come to us, we still take care of them. And at present time, we're looking at a luxury brand, a cosmetic, and a pharma brand.
You've also done tickets for sporting events.
That's correct.
You want to show us this one here?
Sure. What I'm going to show you, this is the UEFA ticket. And the UEFA ticket, as you can see, has an image that is negative or ghost. We call it gray ghosting. And as I tilt it back and forth, you should be able to pick up onto it. It goes on to a very bright, vivid color. This image was made with approximately 2 billion holes or indentations, because the holes don't go through the article, they're just surface indentations. And this little guy here is Super Victor, which was their mascot for the games. Proved out very successful, and they highlighted it on their tickets.
All right, very cool. Now let's talk financials here, Doug. Where do we stand at Nanotech with revenue and earnings and margins?
Starting with our third quarter, which ended June of this year, we became profitable on cash flow basis, or EBITDA. We had a change in direction. We doubled our revenue over the month or a quarter previously, and it came out to about $2.3 million for the quarter. As I said, EBITDA came out positive, and cash flow came out positive, about $700,000. We also have a strong balance sheet on a balance on the bank balance, and that came out to be about $10.3 million.
So are you a takeover candidate, do you think, for some companies?
I think we're too early to be a takeover candidate right now. In this industry, it's old, stable. It's an old boys network. The companies are 200-300 years old that are the big players in it, and they want to see you being successful at having your particular image or your particular product onto a banknote, and at that time you'd become a target by them. But certainly at this time, we're getting a bit of tire kicking and looking around at us.
And lastly, as a pitch to potential investors or shareholders, what do you say to them to convince them that it's the right place to be with Nanotech?
We're a new technology coming into the marketplace. There's nothing like it. We are designed the company up to have a recurring licensing revenue model. So you can look at more of our EBITDA or our bottom line growth opposed to our top line growth. So as we grow a little on the top line, we grow a lot on the bottom line. Something to look at us as a SaaS company. So software, we're delivering a package, and with the package, it all goes bottom line. And our challenge is to change from what we're doing today of delivering a product and going to that licensing. That follows the development product curve, and that's where we're headed. And with that, you should have giant gains in the price of the stock.
From the heart of the financial district in downtown Toronto, that's our show for this week. I'm Mark Bunting. Be sure to subscribe to our YouTube channel so you don't miss an episode. And for more great investment ideas through our weekly digest and morning note, subscribe to capitalideasresearch.com. Thanks a lot for watching, and thanks for investing like a pro. We'll see you next time.